You could have a great idea, a great vision for doing something, but if you don't construct it in the right manner, you're unlikely to have the proper financial resources or the proper unit economics to make that a successful endeavor. So, your vision with the strategy roadmap has great discipline about financially, how do you bring it to fruition?
Welcome to the Strategy at Scale podcast, brought to you by Scaling Up, Outthinker, and the Growth Institute. I'm your host, Kaihan Krippendorf. Our mission is to cut through a sea of conflicting business advice and get to what actually works. We talk to entrepreneurs and business builders who've successfully scaled companies across industries to extract proven high-impact strategies for building long-term value. You just heard from Kurt Miscinski. He is the co-founder, CEO, and president of Cerity Partners, one of the fastest growing firms in the wealth management space. Today, Cerity manages over $130 billion in client assets. But it started with a very different vision: to create the first truly global, enduring professional services firm in wealth, drawing inspiration from firms like McKinsey and Deloitte, but applying it in a field that historically hasn't operated that way. In this conversation, Kurt shares how that vision came to life, not through consolidation, but through a partnership ethos and a language shift that reframed everything from equity to culture. This is a story of architecture, how to build a firm that scales without losing its soul, how to align incentives, ownership, and strategy to fuel long-term value. In this episode, we cover how Kurt went from being a CPA and Deutsche Bank executive to founder of a firm redefining wealth advisory, why Cerity's operating model borrows more from McKinsey than Morgan Stanley, and how that unlocks scale, the strategic philosophy behind reinvesting 100% of profits and how it shaped the firm's culture of ownership, how they use mergers to create a better firm, not just a bigger one, and why that distinction matters, the role of language in shaping culture, from avoiding the word employee to reframing every merger as a partnership, and what every future founder should know about vision, discipline, and modeling their dream into reality. Whether you're building a service business, scaling a partnership, or looking for the infrastructure behind long-term growth, this episode offers a masterclass in how to build something that lasts. Ladies and gentlemen, let's dive in with Kurt Miscinski. Well, Kurt, thank you so much for being here. I know you have a lot of things to do, very busy, and it was not easy to find this spot. So I really appreciate you making the time to talk to us. Thank you. I'm going to open with the two questions that I ask our guests often. The first one is just to get to know you personally. It may have nothing to do with your work or your career or your professional ambitions. Could you complete the sentence for me? If you really know me, you know that.
That I have an endless number of goals. I've always been a very goal-oriented person, both personally, professionally. I think it's just part of my natural makeup and wiring, but always have, a list of things that I wish to accomplish, from Saturday and Sunday mornings, even around my family, to clearly throughout the work week.
How do you keep those in existence for you?
Well, I think it gives me a sense of purpose and an energy. I come from an incredibly modest family and always aspired to be successful, however defined, and just always wanted to be the best version of myself. So always said, if I'm going to do that, I have to put the work in. And by putting the work in, I need to set goals of what am I looking to accomplish. And that has given me a great sense of focus and a purpose, and quite frankly, a great sense of fulfillment throughout the course of my life.
That's awesome. That's inspiring. Do you write them down on paper? Do you write them down digitally? Do you look at them every day? Do you look at them every month? Like what are some practices?
Yeah, some I will write down, but often it's been very good of keeping that mental list. Like I know exactly what I would like to accomplish, and I've never been a person that set out that I'm competing against others. It was always, what am I capable of doing? So to some extent, compete with myself to accomplish something, and what do I need to do that? I've always been a fan of other successes. I've always cheered on others. So I've never been a person that had ill will for others accomplishing things. Quite frankly, I've always looked at it as motivation and inspiration to see others
Mhm.
accomplish things, both personally, such as being a good father, good husband, good friend, good son, and clearly professionally, great business leaders,
Mhm.
entrepreneurs, or just individuals who are effectively at the top of their professional craft, whatever it might be it a doctor, an attorney, or any other profession.
Got it. Yeah. No, it's impressive. I need some kind of like physical something to remind me.
Sure.
But it sounds like you have a a, a a very extensive capability of short-term working memory or whatever that is, that cognitive capacity, which is not surprising at all, given what you have achieved so far. Next question. And we're going to talk a lot about strategy. And we have people who are experts in strategy, who study strategy, and we never get the same answer to this question. So whatever you say is right. What's your definition of strategy?
My definition of strategy is the coming together of a mission, of a vision, and specific actions that need to be taken and executed to accomplish a goal, to accomplish an objective, to accomplish a level of defined success. I've always felt was the definition of strategy.
I love it. I love it. These kind of like three layers of like a pyramid, the mission, the vision, and the choices or something like that makes a lot of sense. So I want to start off by talking about that's not the early part of your professional journey, but the early part of the journey of what has become Cerity Partners, that kind of going from zero to 10, 15, 30 billion assets under management, which is something that anyone in your profession would chalk up as the success. I know you're at 130 billion assets under management. But let's start off with that entrepreneurial journey. So my understanding is you are at Deutsche Bank and you're part of the leadership team in wealth management, and you recognize the opportunity. So I'm going to ask you questions about four different things. How did you recognize this opportunity? What was it that you saw that you could do that could create a competitive advantage? And then talk a little bit about how you operationalize a competitive advantage, because I know you've talked about language and you've talked about systems and processes and people and culture, and then talk to you a little bit of asset allocation as you had grew from zero to the 15 or 30.
Yeah.
To talk us a little bit about, you're at Deutsche Bank, and what do you see? Maybe it's when you met Howard Milstein. What did you see that had you recognize there was an opportunity to do something that became Cerity?
Yeah, maybe a little bit of context for answering that question. I started my career out of school at, in my opinion, one of the greatest professional services firms that were around at the time. It was the largest accounting firm in the world, where I'd interned and then received incredible training to be a true professional service provider. And at the time, probably took it for granted as a young 21-year-old of, boy, I just came out of college. Now here I am at this incredible firm, university system, training, learning, developing, being pushed in a good way to pursue advanced degrees and professional credentials. But all of that instilled a great deal of confidence and knowledge, not arrogance, but confidence and knowledge of I had a command of the subject matter, and I was prepared to be a terrific advisor to clients. Unfortunately, that journey kind of changed with the late 90s and the corporate scandal era that led to changes in the accounting world where the Big Eight collapsed into the Big Four. And then I spent over 10 years at collectively what became part of Deutsche Bank. And so kind of felt that I went from the biggest accounting firm in the world to one of the largest global investment banks in the world. And there was a lot to learn, a lot to learn from a Deutsche Bank, which participated in everything from mergers and acquisition advisory to capital markets to global transaction banking, commercial banking, asset management, wealth management. And I'm very grateful that, that organization put a great deal of development and training into me, including some leadership training. But along the way, what I had contrasted from my early years of experience professionally to my days at Deutsche Bank is that a true professional services firm, I felt, was this great timeless business model. You provide advice and service to your clients for a fee. And I was always enamored with the great enduring professional services firms. So like the McKinsey of management consulting, which will celebrate a 100th anniversary next year. Deloitte, who's arguably the largest in its professional field with a 180-year history, and a law firm like Kirkland Ellis, which is now the largest law firm in the world with 115 years of history. But these are terrific, enduring professional services firms, that play at the top of their professional craft. And I thought, out of curiosity, why wasn't that in wealth management? There's clearly large wealth management divisions embedded within large banks and in some cases in insurance conglomerates, but not a standalone pure global professional services firm in wealth like you would see of McKinsey, BCG, Bain and management consulting, or Deloitte, Price Waterhouse, Ernst Young, KPMG in accounting, or law firms like Kirkland Ellis, Cravath, Swaine and Moore, Davis Polk, Sullivan and Cromwell are to their profession. So was inspired, to write a business plan. I had a little nudging from a few clients who were exceptionally accomplished, who actually approached me and said, if you ever thought about doing something entrepreneurial, let me know. I would welcome the opportunity to back you. And I joked with them and said, apparently I'm not a good advisor. You're encouraging me to do something. But apparently, from their words, there was something they saw in me that seemed that I had either the energy or the aptitude to try something like that. And I don't think up to that point, I ever really would have viewed myself as an entrepreneur. I think I was a hardworking student who then took seriously, being a professional, worked hard to become as good of a professional as I could be. That led to really good things. But, once I started to interact with individuals of terrific and incredible, professional and entrepreneur success, and to have a couple of them, reference, might you consider doing something? Effectively, the seed was planted. And that seed, turned into a green shoot, and enough that at the age of coming up on 33, going into 34, said, might I doodle a little bit of a business plan? And the vision was to build, not to be Kurt's firm, but to be a great and enduring partnership, to be part of building what could be a first of its kind global professional services firm in wealth management in the mold of an enduring partnership. And through time, to build a brand and a reputation arguably as reputable as the McKinsey, a Deloitte, or a Kirkland Ellis are to their profession. So I shared that with a little over 40 individuals with whom I'd worked or knew well from my career up until then. And thankfully, 38 to be exact said, if you do this, I'm in.
Wow.
Terrific. And then the next daunting task came, like, how do we fund this? And that's where serendipity kind of came in. I had been contacted by Howard Milstein, a very accomplished business man in New York, let alone very influential and philanthropic and other circles. And he invited me to come meet with them. And after about 15 minutes of nicety, he said, what would you think about, going into business together? And that took me by pleasant surprise, but I kindly accepted his overture. And that led to then some confidence of, hey, if someone of Howard's accomplishments sees value in building something like this, then, hey, maybe we're onto something. And that journey began at the end of 2009, beginning of 2010. And as my grandfather would frequently remind my sister, brother, myself, sometimes better be lucky than good. It was just very fortuitous timing to start a firm like ours at the bottom of the worst business market cycle we've ever seen, not only in our careers, but quite frankly, I've ever seen in our lives, coming out of the great financial, recession of 2008, 2009. So needless to say, we were afforded wonderful tailwinds of a recovering market. And then there was other secular trends for our industry. I think the great financial recession, and not because I had some great foresight, just because experience did.
So it was really interesting. I started my career at McKinsey, and there is this foundational story the person, not McKinsey, but the person who kind of recognized there was this opportunity to professionalize consulting. And I'm kind of hearing that in what you see. But you said you were 33 or so at that moment. Is that right?
Yeah, that's right. In
Very
fact,
big.
given what you just said, like one of the many books I've read is The Firm, which is
Yeah.
about the development of McKinsey. That was Marvin. It wasn't the
Marvin
first.
Tower, yeah.
It wasn't Bob McKinsey or Tom Carney, and then the ultimate separation into McKinsey and Company and A.T. Carney. But it was Marvin who really decided, like, hey, we could create a true professional services firm. And that's effectively was the vision from day one, that we're going to create this great enduring professional services firm, firm that has great commitment to developing every colleague to be at the highest of their professional craft. I mean, just a few years ago, I invited Bob Sternfeld, who's the current global managing partner of McKinsey, to come speak to one of our annual partner offsites. And I asked Bob in front of my partners, how much do you invest in education and development? And that year that he was there, he said, this past year, we invested $1 billion. Wow. That kind of translates to over $20,000 per colleague of McKinsey. And to me, that's a great professional service for firms that are investing. If you take a look at Deloitte, Deloitte has 465,000 professionals globally. They have 20,000 partners at that firm. But if you've never been to their global university in Westlake, it's, it rivals the top universities in the world. So in my opinion, this vision of being this great enduring professional services firm, starts with the foundation of this commitment of how do you create a professional service firm? How do you support that? And then you probably experienced that at McKinsey yourself, with probably great training and development.
Yes. Yeah, we had David Wharton, who wrote a book called Evergreen Company, and he was talking about kind of part of the dilemma is kind of hearing it here, and I might be off, but it's like in financial services, there's a little bit of a shopping around, right? Like, I'll go from one firm to the other, and whoever pays me the most in that year, my book starts again from scratch, and I will, just jump around where I can get the best deal. But then there is a disincentive for the firm to invest in people. And so, like, to invest in people in year 1, 2, 3, 4, you got to kind of have, if you're looking at employee lifetime value, you got to kind of look at that this person's going to be around years 3, 4, 5, 6, 7. But it seems like you were able to, you saw you were able to, and you were able to overcome that dilemma.
I think part of it was, having an ethos from day one of build a palace, not a prison. Build a place everyone wants to be, build a place where we're all contributing to this great palace that we're in. Again, our firm was never founded to be my firm or to be a few of our firms. It was created to be a thriving and enduring partnership, a firm owned by its partners. And I think that mindset, that cultural mindset, that partners of our firm, like they are business owners of our firm, a level of care and attention to take care of our partnership, to train, develop the next generation of colleague who was going to be the successor to all of us, to continue to serve our clients and generations of our clients. And so feel, rightly or wrongly, that a partnership culture, has a different dynamic, one in which there's great interest to want to be there for 20, 30, 40 years, one in which partners of the firm could do great things for clients as well as have their own personal wealth creation opportunity. And I think if you could align those two objectives, you'll have great tenure without high levels of turnover, because we don't even use the word employee in our firm. We're colleagues and we're partners. We only have clients. We don't have customers, deals, or transactions. We never acquire anyone or anything. We merge with another firm to create a better firm. We're not a consolidator, aggregator, or a roll-up. Like, would you say McKinsey's a consolidator, aggregator, roll-up, even though they've had many mergers and acquisitions to get different expertise and talent? You look at Deloitte's 180-year history, hundreds of mergers to become who they are today. And that's a mindset. It's a mindset of, like, this is a professional services firm in the mold of a partnership. We're building it together. We share success based on meritocracy. of how we're contributing. So we purposely built our firm that you could have as good or better of an entrepreneur opportunity within our firm than if you just try to do it on your own. And that based on sharing success on meritocracy, your economic opportunity could be equally as good, but there's just really many more resources within our firm, to be able to leverage to create that opportunity for oneself.
I love that you went into the language because, what I'm hearing is you have this concept and then you kind of operationalize this concept. And I do believe my father was a professor of communications for 58 years. And so I really kind of come from this idea of this social constructionism, that the language that you use shapes the options that you see and how people think and shapes our perceived reality. What are some of the other things that you looked at in terms of creating this idea of we are a partnership in addition to the language? What systems, what processes, what incentive structures? One of the things, as I understand, the divergence of, McKinsey breaks up and there becomes A.T. Kearney and McKinsey. And one of the big differences is that McKinsey has one profit pool that's shared across all partners as opposed to having regional or office level. So what are some of the more other tangible things that you did to really design the organization to lean into this differentiated?
Yeah, first it started with the design of this will be a partnership, and therefore there needs to be a partnership agreement that clearly lays out effectively the manifesto that we partners of the firm, these are the things we agree of what we should be doing as partners. And here is how we actually have true effect on how our partnership is shaped. So within our partnership agreement, it is really clear on what requires a vote of the partnership to conduct certain activities, to do the things that we wish to do. And then separate from that, we thought if we're a group of partners, great partnerships have very little hierarchy, meaning it's not about being 15, deep into an organizational structure. So we purposely have been building a very flat organization. We're a group of partners, and each one of us as partners, we have our responsibilities. So a partner whose job is to develop and serve clients, your responsibilities. The partner of our firm is to be our chief financial officer. That's that partner's responsibilities. My responsibilities, help lead the firm to go pursue our mission, our vision, our strategy, roadmap, make sure we have the right organizational design and the right colleagues and the right roles to do everything. So we don't look at it as any one partner is more important than the next. We simply have each of us partners have our roles and responsibilities. Then from that, it's the sharing success on meritocracy. So how we share the firm's cash flow and how we even share our firm's equity is based on partners' contribution to the growth and the profitability of the firm. So any partner in our firm could become the firm's largest shareholder if he or she simply earned it through contribution to helping the firm grow, clearly in terms of revenue and profit, which has the high correlation to value of the firm. And so, in our firm, effectively, it works this way. If you're contributing to the growth of the firm at the average partner's contribution, your ownership will stay roughly the same. If you're contributing above the average partner, your ownership will start to climb in terms of percent ownership. Conversely, if you're contributing below the average partner, then other partners are receiving more incentive equity, and therefore your percent ownership will decline. But whether your percent ownership is declining, flat, or rising, as long as the value of our firm continues to rise, the value of all partners' capital accounts continue to rise and appreciate. And I'll have to say, when I reflect on my entire career, it seems so obvious of this works so brilliantly. Why wasn't it working that way elsewhere? But, different dynamics. Not every organization is a partnership. Some are true companies and which, ownership is held predominantly outside of the firm, where most companies, publicly traded companies, probably at best, the ownership held by people in the firm is, 10% or less, and ownership outside the firm, 90% or more. But, partnerships that have 40, 50, 60, 70, 80%, or maybe as much as 100% ownership within the firm, then you have the opportunity to say, how are we sharing this in success? And so I feel these have been the key ingredients for helping our firm grow and thrive. Granted, far from perfect, always continuing to challenge ourselves on
Mhm.
where can we get better, but we have those discussions openly with each other. Every year we have an annual partner offsite, and a third of that time is just building relationships. I have always felt if you become friends with your colleagues and your partners, you could get through any spirited discussion. If you don't have those relationships, people are more inclined to dig the heels in the sand, if you will, on almost any topic. But when you know someone, you respect someone, you trust someone, if they have a different view, you respect that they have a different view. If you don't know them well and they have a different view, you often have a different and, quite frankly, more of an adverse reaction to that. So we spend a lot of time with that. Then secondly, we talk about strategically, what do we want to accomplish in the next 3 to 5 years? Align on that. Say, great. So now it's never a surprise when we're doing things towards that. And then lastly, it's always important to talk about the more tactical things, like what are the hot buttons in the firm? What are things that we need to remedy like quickly in the next 3, 6, 9 months because they're pain points and they're frustrating people or it's taking away people's energy. So we're fairly disciplined in that, making sure we get together for a meaningful amount of time every year, and knocking off those strategic and tactical things that need to get done, as well as making every partner truly feel like I'm part of shaping that. Like I'm not just the order taker. Like I'm part of like how we're doing this. And so our hope is we could do that for the foreseeable future. Now, clearly, as we get bigger, it becomes more challenging of how do you do that. You probably saw a little bit of that at McKinsey, like how do you harness, a growing organization to still have that intimacy of this great partnership. But I still see evidence that very large partnerships have been able to do it.
Mm-hmm. So let's just double click on like one aspect of those kinds of decisions that you're making. I just want to go a little bit to asset allocation, reinvestment choices, right? So we'll talk later about you've had a really diverse set of acquisitions that have or mergers that have expanded your capabilities. But you being a CPA, you being a wealth advisor, and now and running a firm, I imagine that you have a mindset or a way of thinking of what do we do with the profits? How much do we distribute? And then what do we reinvest? And when we reinvest, do we reinvest in the core or Horizon 1 or Horizon 2 or what new areas? Just maybe you could just tell us if you have a philosophy on capital allocation.
Yeah, we do. First, we're very disciplined around the traditional 5-year plan, as in like truly developing a 5-year plan with a 5-year financial and capital plan. So we're currently on our third 5-year plan. I'm very proud to report the last 2 5-year plans. We've outperformed, and I would be remiss not to say past performance is no indication of future results, but feel that that discipline creates much clarity in our firm. We have made a decision since we founded the firm to reinvest all profit in the firm. Because if we're going to be a 100-year-old firm, very nervous about, distributions. I say to be funny, those first distributions could be effectively like the gateway drug that once you turn them on, turning them off becomes very, very difficult. So we've designed a compensation philosophy within the firm that appropriately compensates colleagues and very competitively for what everyone's roles and responsibilities are. But that as partners of the firm, we're building this terrific firm that even though going on 16 years, feel very young, relative to what we're trying to build that's enduring. So we need to reinvest. And that has served partners here well because the compound annual growth of partners' equity has been very high. So thankfully, that has been the saving grace of no partners questioning about might we distribute profits because when they see the balances of their capital accounts going, all right, this is working well. And so I think down the road, be it 5 years, 10 years, 20 years, there might be a point where the pace of growth and your growth in equity might slow a bit, and then you might entertain for the first time, might we now complement this by distributing some profit? And you could get to a point where you have so much profit, you don't have ways to put that all to work, and then therefore, distribute it out to the shareholders. of the firm. But thus far, we've reinvested every dollar of profit since we started the firm.
Is there and this may be a little tactical here, but is there a mechanism for a partner that's approaching retirement and just, wants to?
There is. Yeah, we have it all clearly defined in our partnership agreement. But when partners of our firm, decide to retire, the value of their capital account at retirement, they have one of two options: to take it over 12 consecutive quarters, where it allows an orderly way for them to get liquidity, and it allows all the other partners of the firm to purchase that equity in an orderly way. Or option two, if they would like to take it over a long period of time, which is 5 years, and still keep their equity in the common equity of the firm. So whatever portion is not redeemed on an annual basis, they're still participating in the common equity and growth of the firm.
Fascinating. Okay, so then I'm going to switch a little bit now to at scale, right? So let's just imagine, you've crossed 30 billion at some point, and now you're headed towards 130 billion assets under management. Where does strategy fit? Where does it sit? Because strategy can be M&A decisions, it could be KPIs, it could be your board presentations, it could be the internal consulting, it could be operations, so many different things that strategy could be. And in a flat organization, as you have, and especially I found in financial services, it's not always clear where strategy should fit. So where does this fit for you? Do you have a strategy office? Do the different partners run their own strategy? Where are those decisions located?
Yeah, I would say I'll answer it now, but in the first easily 7-10 years, when we're a more modestly sized firm, you just simply couldn't afford, to have a colleague dedicated to thinking about strategy. So it's, whether you're the founder of a firm or you're a co-founder, but effectively that concept of the co-founders have a vision of what they want to build, have a strategy roadmap, hopefully put together a disciplined 5-year plan or something equivalent. And now you're executing, blocking and tackling, and of course, iterating, because certain things you thought were going to happen don't, and you got to pivot. So you got to be very agile as saying, hey, that's not working as well as we thought. Might there be a better way? But as you start to mature and as you start to reach scale, and so as we're now, we went from a scrappy startup 15 years ago to now 1,500, colleagues and professionals of our firm are a different size firm. And now we've evolved many different capabilities. So now strategy and execution of that becomes increasingly important, and therefore now need to have, a dedicated group or groups of colleagues. So, formed and, for the first time, a true kind of chief growth officer, strategy officer to say, hey, we need somebody to make sure that every given day they're looking at the landscape, looking into the marketplace, like what is all possible? Where's that effectively green space, white space? Where does we see the intersection of unmet needs in which we are so well equipped to deliver against those unmet needs? How do we better position in the marketplace? How are we being responsive to new innovation and things that are disruptive? And how are we pivoting? And so that, now, we have developed, but that took nearly 13, 14 years of our 15 years to get to. Mm-hmm. So we now feel that we're in the place. We have a terrific leadership team, very open, very transparent, with each other. So there's no secrets, if you will. It's, we talk about these things, but we definitely charge few of these colleagues. Your responsibility is to make sure we are all well educated on what the trends are. And if you're a hockey fan, where's the puck going? Because we need to be skating to where the puck's going, not where the puck's at.
Yeah, because I would think, especially with a less centralized organizational structure, you can get this proliferation of visions. Well, I guess visions maybe you can bring together, but what are our competitive advantages? What are the heuristics that we would use to say that this is the kind of thing that we are? We're a partnership. We are a we're a fiduciary. You probably have certain principles. So maybe just talk to me about what some of those principles are that maybe speak to what you see as your competitive differentiators versus your competition.
Yeah, we feel that we're building those competitive differentiators. Definitely we're a humble group of professionals in our in our firm, not believing, we're the greatest thing since sliced bread or we've cornered the market on great ideas. I think what we are positioning and building, to be competitive is this enduring firm whose brand, stands for stability, stands for excellence. And we feel that in our industry, there's not many brands that have established that, not many brands that have established themselves in wealth like a Deloitte is to its field, like a McKinsey is to its field. Thus, that vision for building a first of its kind global professional services firm. And so, although we have a full suite of services, although I believe we have a timeless business model of offering advice and service for a fee, although we operate of not trying to sell our clients things versus advising them where they never have to question, is this good for you? Is it good for me? But really feel at all times that what we recommend and the advice that we render is truly in their best interest and it's good for them. And it's the building upon that trust, but backed by the demonstration that the professionals at our firm are at the highest in their professional craft, and then do that through enough time. And now you've secured your competitive advantage. And that is the brand trust and loyalty that, hey, before you make your decision, you should talk to Cerity Partners. Like, to me, that's the best litmus test we have for brand identity, that the increasing number of prospective clients who inbound inquiry to us to say, I was told by a friend, by a family member, from what I heard, I needed to check with your firm to see if you would be the perfect provider before I made a decision. Ultimately, in our profession, there still needs to be great chemistry between people. So although you could have the perfect brand and the perfect capabilities, the colleague in front of any particular prospective client needs to be able to create, the bond and the personal chemistry, because there's still ultimately a bit of the personal choice. Yes. People are people. And so not everyone is solely enamored with a brand name. A lot of people are driven by relationships. So if they met Tom and they really liked Tom's nature and how Tom did, and Tom was at this firm they heard of that had a great reputation, clearly the probability of success is high, but it still requires Tom to have a great connection, have high EQ, with the client.
So, this brings up an interesting challenge that we see a lot of firms, and I'm saying firms just because we're talking about financial services, but companies, which is CLV, or in your case, client lifetime value. Like, I've got a relationship with Tom, but you have all these other capabilities now. We'll talk about Touchdown Ventures and your CVC capabilities, and how do you because I could just be a Tom customer,
yeah,
right, and not have benefit from these other capabilities that Cerity offers. How do you maintain the coordination of these different capabilities?
Yeah, well, I view as being a professional services firm, whether you came up in management consulting, accounting, the legal profession, and others, you start with your core clientele and you serve your clients to the best of your ability. You're constantly assessing, are there any unmet needs that our clients have? And if so, how could we curate that? How do we bring them, services and solutions for those unmet needs? And then as you continue to grow, you start to assess, what type of clients are we serving? Are they business founders? Are they corporate executives? Are they, highly accomplished professionals? Are they entertainer and athletes? But you start to look and say, where are we really being successful? Where does our service resonate? So we are a full service firm. Mm-hmm. Why is that relevant? Because regardless of your level of wealth, you could easily be dealing with 5 or more advisors: an attorney for your trust and estate planning, an accountant for your tax planning and preparation, a financial planner to make sure you understand, like, what's my roadmap, one or multiple bankers. You might need loans and depository products and things of that nature. Every one of us need various insurance solutions: life, disability, long-term care, property, casualty. And so for a typical individual, especially an active wealth creator, you often simply don't have the time or the interest to chase 5 or 6 different advisors and be at your home office on a Saturday with a bunch of documents in front of you going like, all right, I got to make sense of all this. And what do I do? And you're probably frustrated after a long week because now I got to fill out forms and get this done and follow up. And of course, no one's available for my questions right here on a Saturday. So then Monday, I'm already busy at work. We got to have to figure out time. So that I repeat all this because this is what drives frustration. And so that's why from day one, we built a full service firm, because among the things we do that are very valuable to our clients is we do it all, so that our clients don't have homework, our clients don't have that administration work, our clients don't have that follow-up, and everything they're doing in their financial lives coordinated.
Yeah.
And it's congruous with one another. Yeah. So that in of itself became powerful. Now, for some of the other capabilities, we said, wow, we serve a number of business founders and leaders. And then they started asking us, because of our investment acumen, hey, what do you think about this sector, this industry? And often they were asking because it was of interest to them, because those areas might be a competitive threat, or these certain companies might be a competitive threat to their own business, to their own franchise. And really, that's what led us then to develop having a corporate venture capital advisory service to say, might we be of value to our private clients who are leaders of companies by having a group of colleagues who have the breadth and depth of expertise to help them with their companies, invest in startup and early growth stage businesses that will help them remain innovative and competitive, maybe give them a pipeline of future talent, maybe give them a pipeline of future mergers and acquisitions. Right. And so that's what led us to say that's a natural evolution. Furthermore, and a growing number of our private clients have a growing interest to invest in startup and early growth stage businesses. And now, because we're helping our large corporate clients, make those investments, often there's opportunities to invest alongside big companies in a startup. I'm early growth stage business. So it all comes together very powerfully, but all led by what's the next extension of how we could be of value to our clients.
Yes. I gotcha. And when do those conversations come together where you get the full view around the client of what else could we do? Because I've seen, like, in your acquisitions, I've just looked up some of them here. Like you acquire Cook Wealth that expands into Raleigh, Janisek Wealth and Denver. You got these regional acquisitions, but then you have these customer segment or client segment acquisitions, like Agility gets you into nonprofits. But this CVC acquisition or merger is a whole capability. So I would think that when do you guys, is it in the annual partner meeting where you guys do this, or is it?
Yeah, it's part of our
always or
yeah, no, definitely part of the planning process. So when we talk about, hey, the next 3 to 5 years, what capabilities do we not have today that would be powerful for us to have to better serve our clients, to better put us in a position to grow more powerfully because of these capabilities. And then we set course. We identify, what capabilities would be beneficial. And then we are very methodic. Like, how do we go find the best individuals to be our colleagues and partners to do it? Do we simply hire really talented people to be our colleagues and build it de novo? Or do we find a group of colleagues who just happen to have their own firm, already proven an ability to do it at a very high level, and effectively we merge to now have this capability and to create a better firm? So last year was a terrific year for that. We identified, probably 2 to 3 years ago, hey, corporate venture capital advisory would be a powerful service. How might we incorporate that? We also identified that, hey, many of our clients, our private clients, are major benefactors to foundations and endowments, or they serve on the board of trustees of academic institutions or on investment committees of foundations and endowments. And over the years, we probably received several hundred RFPs from our clients saying, I love what you do for me. Might you also do this for the liberal art, college that I'm on the board of trustees? Well, we would get their RFP and we open it up. And of course, rightly so, the RFP would ask, how many of these do you have? Are you GIPS compliant? And show us your track record for doing this with other institutions. So that identified to us, boy, if we had that capability, that'd be very powerful. So we set out to go find that. And we welcomed 60 incredible colleagues with our merger with Agility, of which 3 of our colleagues who are partners of our firm were the former CIOs of large university endowments, which gives us incredible, expertise and credibility to do it. We now have a long-standing, top-performing track record that's, compliant with measurements of investment performance. So now the next wave of those opportunities, we are so well positioned to be successful. And so that was something we identified just as recently as 3 years ago and already mobilized and now already have the solution for it. And of all the things we did in the first quarter of this year, that was the biggest contributor to growth. And that capability was just something we developed in the last year. Mm-hmm. So if you have the right capabilities in the right situation, they could be activated quickly and powerfully because there was effectively that pent-up demand.
Yes. Yeah, and you have a system, a culture, a partner mindset that makes agility and touchdown, view you as the natural thing to add on to.
Right.
It's very smart. I'm starting to see the flywheel now. What advice do you have for that 33-year-old potentially future entrepreneur who's thinking of it? What would be your advice?
Advice to myself, looking back where hindsight's 2020, clearly would say have a very clear vision of what you believe you're trying to build, and then put much discipline into that vision. And maybe it's the accountant in me or the finance, individual in me, but I find great comfort in financial models. Not that they're the end all be all, but they're a great reality check. Because you could have a great idea, a great vision for doing something, but if you don't construct it in the right manner, you're unlikely to have the proper financial resources or the proper unit economics to make that a successful endeavor. So I would say my guidance is whatever your great idea is that you're passionate about, you need that. You need that passion to get through those early years when things always don't work perfectly. But it needs to be rooted in really strong financial discipline. And if you yourself don't possess that, that's okay, but you need someone else as part of that day one journey who is very disciplined around that so that, your vision with the strategy roadmap has great discipline about financially, how do you bring it to fruition?
It's sort of like the strategies kind of envision, checkmate, and work backward from there. The discipline of coming up with a financial model, even though it's not going to be exactly the truth. I think it's the process of doing it, the thinking, the math to see what a possible path is to that long term makes it real.
Yep.
I have so many other questions, but we've reached the top of our time with you, Kurt. Thank you so much for staying with us and sharing your experience here. You've got a number of podcasts that you've participated. You contribute a lot and very generous with your time. Any last comment for our listeners that you'd like to share?
No, just a thank you. Very much appreciated the invitation to join you here on the podcast, and big fan of what you're doing. I'll continue to follow you. Thank you.
Awesome. Thank you, Kurt.
Appreciate it. Have a great weekend.
Appreciate it. You too. Thanks for listening to this episode of Strategy at Scale. Thank you to our guest, Kurt Miscinski, our producer, Oscar Perez, and our teams at Scaling Up, Outthinker, and Growth Institute. If you like what you heard, please follow, download, and subscribe. I'm Kaihan Krippendorf. We'll catch you soon with another episode of Strategy at Scale.